somewhere inside a quiet tower in Jakarta. A vault is filling up faster than almost anyone in global finance predicted. Not with cash, not with bonds, with gold. 153 tons of it, worth roughly $20 billion, accumulated in a single year inside a country that, until recently, had no domestic gold banking system at all. Central bankers in London are watching. Analysts in Zurich are recalculating. And somewhere in Washington, a very old assumption about who controls the world's gold is quietly being tested. Because this is not just a story about a bank. This is a story about a nation deciding it no longer wants to rent its own wealth back from someone else. And by the end of this video, the question won't be if other nations follow Indonesia's lead. It will be which one moves next. Welcome back to Precious Metals Intelligence, the channel built for people who don't just watch the markets. They read the signals underneath them. Before this story unfolds, it would mean a great deal to know who's tuned in tonight. So, respectfully, wherever you're watching from, whichever city, whichever country, take a moment and let us know in the comments below. This channel is watched by careful, deliberate people all over the world, and it's always worth knowing where this community is gathered. It happened on a Monday inside a plenary cabinet meeting in Jakarta. President Prabowo Subianto stood before his ministers and made an announcement that would soon travel far beyond the walls of that room. He said that Indonesia's Bullion bank had, in just 1 year, managed 153 tons of gold. The value of that gold was close to $20 billion US. For most people, a number like that is hard to picture, so it helps to slow down and think about what 153 tons actually means. It is more gold than the entire official reserves held by countries like South Korea, Sweden, or Singapore. It is more gold than Canada holds in its national reserves, because Canada, in fact, holds almost none. In other words, in a single year, Indonesia built a gold position larger than what many established nations have accumulated over decades. President Prabowo called it a historic milestone. He said it reflected the country's growing economic strength, something the rest of the world was now being forced to notice. And he was right to call it historic, because Indonesia had never had anything like this before. This was the first time in the nation's history that it operated its own bullion bank. To understand why this matters, it helps to know what a bullion bank actually does. It is not a place where ordinary people walk in to deposit paychecks. A bullion bank manages physical gold and silver. It stores the metal, finances it, trades it, and lends against it. For most of modern history, countries like Indonesia did not have this kind of institution. They mined the raw gold, then shipped it overseas to be refined, stored, and traded by banks in places like London or Zurich. The gold belonged to Indonesia, but the profit from managing that gold often did not. That changed on February 20th, 2025, when Indonesia's bullion bank officially launched. The government chose two institutions to run it. One was PT Pegadaian, a state-owned pawnshop with a long history of helping ordinary Indonesians borrow money using gold and other valuables as collateral. The other was Bank Syariah, Indonesia, the country's largest Islamic bank. At first glance, neither of these looks like the kind of institution that should be managing a sovereign gold strategy. A pawnshop and a religious bank do not sound like Wall Street, but that is exactly what made the plan work. Both institutions already had deep relationships with everyday Indonesians who owned gold, whether as jewelry, savings, or family inheritance. Instead of building something new from nothing, the government used institutions people already trusted. The results came quickly. Within the first year, the number of customers at Pegadaian's gold services grew from just over 3 million to more than 5.5 million. Gold savings held at Pegadaian nearly doubled. At Bank Syariah, Indonesia, total gold under management grew as well, and the number of people opening gold savings accounts jumped sharply in only a matter of months. This was not a program driven only by government policy. It was a program that ordinary citizens chose to join in large numbers in a very short amount of time. For decades, Indonesia faced a problem that many resource-rich nations know all too well. It had the gold. It had one of the richest mines on the planet sitting inside its own borders. Yet it did not have the system to turn that gold into lasting financial power. The raw metal would leave the country, get refined somewhere else, get traded somewhere else, and generate profit for banks somewhere else. Indonesia kept the mine. Other nations kept the money. This pattern has a name in economics. It is called the resource curse. A country full of valuable natural resources exports them cheaply, then buys back finished, processed goods at a much higher price. The nation with the raw material rarely captures the biggest share of the reward. Indonesia lived this pattern with gold for generations, even while operating Grasberg, one of the largest gold and copper mines in the entire world. The bullion bank was built to break that pattern. Once physical gold sits inside a domestic banking system instead of leaving the country, everything changes. Local miners can now borrow against their own gold instead of asking foreign banks for financing. They can hedge their production inside their own country. They can store their reserves at home instead of paying storage fees abroad. In simple terms, Gold that used to be raw wealth sitting underground can now become active capital moving through the domestic economy. This is not the first time Indonesia has tried this approach. A similar move happened with nickel. A few years before the Bullion Bank existed, the government banned the export of raw, unprocessed nickel ore. At the time, this decision surprised many international buyers, especially companies building electric vehicles who depended on Indonesian nickel. But the ban forced something important to happen. Global manufacturers who wanted Indonesian nickel now had to build processing plants inside Indonesia itself, rather than simply shipping the raw material out. The result was a wave of new domestic industry, new jobs, and new revenue that stayed inside the country instead of leaving it. Indonesian officials refer to this broader strategy using a local term, hilirisasi, which roughly means economic downstreaming. The idea is simple to explain, even if it is difficult to execute. Instead of exporting raw materials and letting other countries capture the value through processing and finance, Indonesia keeps that value at home. First, it happened with nickel. Now the same thinking has been applied to gold. President Prabowo has described the Bullion Bank as a direct reflection of what he calls Indonesia's growing economic sovereignty. That phrase matters. Sovereignty, in this context, does not only mean political independence, it means financial independence too. A country that controls the vaulting, financing, and trading of its own gold is no longer dependent on foreign institutions to manage its own wealth. It sets its own terms. There's also a quieter benefit happening at street level, far away from cabinet meetings and formal announcements. Ordinary Indonesian citizens have long held gold as jewelry, as family savings, and as protection against uncertain times. Much of that gold sat outside the formal banking system, untouched by loans, savings accounts, or any structured financial product. The Bullion Bank gives everyday people a legitimate, government-backed way to bring that gold into the financial system. They can open gold savings accounts. They can use gold as collateral. They can participate in a financial system that, until recently, simply did not include them in this way. This is part of why the growth numbers moved so quickly in just 1 year. It was not only large institutional players adjusting their strategy, it was millions of ordinary citizens deciding to bring gold they already owned into a new, trusted domestic system. When that much private gold moves into a formal banking structure at once, it does not just help. Indonesia did not make this move in isolation. To understand why the timing matters so much, it helps to step back and look at what has been happening around the world since 2022. That year marked a turning point for many governments that hold large foreign currency reserves. When sanctions froze the sovereign assets of one major economy almost overnight, other nations watched closely. They saw that money held in foreign banks, denominated in foreign currency, could be frozen or restricted by decisions made outside their own borders. That single event changed how many finance ministries thought about risk. Paper reserves stored abroad suddenly looked less safe than they once did. Gold offered something different. Physical gold, held inside a nation's own vaults, does not depend on another country's banking system. It cannot be frozen by a foreign government the same way a bank account can. It carries what economists call zero counterparty risk, as long as the metal is actually in the country's own possession. This is why, since 2022, central banks around the world have been buying physical gold at a pace not seen in decades. This buying has been especially strong across Eastern Europe, parts of Asia, and countries often grouped together as the Global South. Indonesia's Bullion Bank fits directly into this larger pattern. It is not simply a domestic banking project. It is one part of a much bigger, informal shift happening across many nations at once, all moving in the same general direction. Fewer nations want to rely fully on foreign currency and foreign institutions to hold their wealth. More nations want physical assets they can control directly. The scale of this shift becomes clearer when looking at the US dollar's role in global reserves over time. In 2002, the dollar made up roughly 72% of global reserves and transactions. That was a dominant position, almost unchallenged. By 2026, that share had fallen to somewhere between 57 and 58%. A drop of that size, over roughly 2 decades, is significant. It does not mean the dollar has lost its central role in the world economy. It remains the most widely used currency for trade and reserves by a wide margin. But the trend line is unmistakable, and gold has been one of the main beneficiaries of that shift. This is the environment in which Indonesia's $20 billion milestone should be understood. It is not just a national achievement. It is a signal that fits neatly into a global pattern of nations trying to strengthen their financial independence. When a country controls a large amount of gold liquidity inside its own borders, it becomes better protected against currency swings and external economic shocks. It gives that nation more room to act on its own terms during moments of global stress, rather than depending entirely on foreign markets and foreign currencies. There's also a symbolic layer to this story that deserves attention. For a long time, discussions about de-dollarization and gold accumulation were dominated by large economies, the kind of countries whose central bank decisions make front-page financial news. Indonesia is a large country by population, but it has not traditionally been seen as one of the leading voices in this conversation. Its Bullion Bank changes that. It shows that this shift toward physical gold and financial self-reliance is not limited to a handful of major powers. It is spreading to resource-rich nations of many different sizes, each looking for the same basic protection. Analysts watching this trend point out that once one resource-rich nation builds a successful domestic gold banking model, it tends to draw attention from others facing similar circumstances. Nations sitting on large mineral wealth, but without the financial infrastructure to fully capture its value, now have a working example to study. Indonesia spent years developing the system, starting long before the Bullion Bank officially launched, and its results in year one gave other governments a real case study rather than a theoretical idea. This raises an important question for what comes next. If de-dollarization and gold accumulation continue at this pace, and if more resource-rich nations follow a similar path, the effects will not stay contained inside any single country's borders. They will begin to touch global gold supply, global pricing, and the balance of financial power itself. That is exactly where the story moves next. Once a resource-rich nation begins locking up its own gold instead of exporting it, the effects do not stay confined to that nation alone. They begin to touch the entire global gold market. Here's the basic mechanic behind this. For years, much of Indonesia's gold production moved outward into international trading networks and foreign vaults, where it added to the available global supply. Now, a growing share of that same gold is staying inside Indonesia, held in domestic accounts, domestic vaults, and domestic savings products. Every ton that stays home is a ton that no longer flows freely through international spot markets. When enough countries start doing this at the same time, the available global supply tightens. And when supply tightens while demand stays steady or grows, prices tend to move in one direction. This is not a small or temporary shift. It reflects a change in behavior among the very people who own and produce gold. Miners who once sold their production quickly, often to meet financing needs, can now hold gold longer and borrow against it instead. Everyday citizens who once kept jewelry and gold savings outside the formal system are now placing that same gold into structured accounts, where it becomes part of a larger managed pool rather than something that might eventually be sold on the open market. Both of these behaviors reduce the amount of gold moving freely through global trade, even without any government directly restricting exports. Analysts who study commodity markets often describe this kind of shift as slow-moving but structural, meaning it does not create a single dramatic event, but instead builds gradual pressure over time. A $20 billion accumulation from one country in 1 year will not, by itself, transform global gold pricing overnight. But it changes the underlying trend, and trends, especially in commodities, tend to matter more over the long run than isolated headlines. This is also where Indonesia's success becomes something larger than a domestic story. Other resource-rich nations are now watching closely, studying exactly how Indonesia built this system in such a short period of time. Countries like Ghana, Mongolia, and Nigeria all share a similar starting position. Each holds meaningful gold reserves or gold production. Each has, historically, exported much of that raw wealth rather than managing it domestically. Indonesia has now shown a working model these countries can study directly, rather than a theory they would need to build from nothing. If even a handful of these nations follow a similar path over the coming years, the cumulative effect on global gold supply could become significant. This would not happen through any coordinated agreement between these countries. It would happen simply because each nation, acting in its own interest, chooses a similar strategy at a similar moment in history, for very similar reasons. That kind of parallel movement, even without formal coordination, can still reshape a global market. There is also a shift in influence to consider, separate from price alone. For a long time, the major financial centers that control global gold trading and storage have been concentrated in a small number of cities, places like London, Zurich, and New York. As more resource-rich nations build their own bullion banking systems, some of that influence naturally moves away from those traditional centers and toward the countries that actually produce the gold in the first place. This does not mean established hubs will lose their importance quickly, but it does mean their position is no longer as unquestioned as it once was. Indonesia's $20 billion milestone, then, is not simply a national success story. It is one data point inside a much larger pattern reshaping how gold moves, who controls it, and where global financial power is slowly beginning to shift. And that raises the final question this story needs to answer: what happens next, both for Indonesia and for every nation now watching its example closely?